Hey everyone, it is Ian, and today we're going to be going over qualitative risk factors with individual companies. Now, this is different than some of the other topics that we've discussed previously. For example, we were talking about the BLS data, the CPI data, and how this could, affect the individual egg company that we looked at, ticker symbol CALM. This is a little bit different, right? This is individual company risks, and a great example is on ticker symbol SAVA, the SAVA Sciences. I think that there is definitely some trade idea juice in here, but I will show the data in that sense, but I'm not gonna recommend a trade per se, or make a trade idea out of this because it's Cassava Sciences. This is a biotech, and I think you'll realize why. But nevertheless, what we're going to cover in today's video is essentially trying our best with the available data at hand to analyze, is this cheap or expensive? Now, this is an art. This is not a science. This is an art. Um, and I really recommend a lot of experience, a lot of back experience with this fundamental data. So a familiarity in the biotech space, a familiarity in medical science and research is probably more prudent than not having it if you're going to use this. But nevertheless, we're going to go over this and delve into it a little bit deeper because while we may not understand all the specifics of the the research and the chemistry behind it, what we can understand is, okay, is this risk or is this not risk, right? And that's what we're going to cover. First, let's go over the numbers, right? We're on the scanner here, and once again want to go over my scan for the newer guys. What you're going to see, again, is price, option, volume. We want to find stuff that's decently liquid here to get in, get out. Do not want something with an event. We want to sort the IV 30 versus the forecast volatility ratio, which basically says how much is this individual stock implying for its next 30 days versus what we think, what our forecast thinks, right? So going through that, next we have the IV30 above 26. Basically, what this is we don't want to be selling vol on something that's implying like 6%, right? There's not a lot of juice in there. It's not a whole lot of bang for our buck, so to speak. We also want a non-event IV30 percentile above 50 because, relatively speaking, you do not want to be selling something, usually that is, when it's extremely cheap relative to what it's usually at, right? So once we have all those factors put into play, you're going to notice that one of the first things that come up is a small cap, air quote small cap, um, Cassava Sciences, right? Now, what we're gonna notice here right off the top is the IV 30 versus forecast volatility 30 of 1.66. So it's implying a lot more, 66% more than what we are forecasting. For example, this is currently implying 164% vol for the next 30 days, and we are only forecasting 98.5. So this is a huge difference, which is always great to see. Another thing that we're seeing here is that the realized volatility for the last 20 days is only 111, right? Versus the implied of 164. So that is also a great sign. We also have non-event IB 30 percentile of 71. So that means that this is in the top 29% of what it's been implying for the past year. All good stuff, right? All good stuff, right? Now, over here on the key metrics, we can see that the 1 day implied move on Cassava Sciences is 10.5%. That is ridiculous, right? That is definitely something that definitely appears to be optimal. Lastly, spot vol regression here, we can see it's a negative, right? So this kind of validates it here. We see the share price has fallen all the way down to 29 bucks from a high of 44 bucks in the middle of December, and consequently, we've seen implied volatility rise exceptionally. Now, all of this looks good. All of this looks great. But now we have to figure out why this is. And with biotechs, guys, they're not like your standard run-in-the-mill company like a Kroger, like an ExxonMobil, where it's really easy to analyze the risk factors. For example, Kroger right now may have risk factors with their inventory. That's easy. Just look at how they're how quick they're able to get their inventory off their books. Look at how they're able to retain consumers while not um having to cut prices as much, right? Things of that nature. Basically, how good are they able to combat inflation without cutting into their profits, right? Now, drug companies and especially clinical research drug companies are a lot different. You have to actually look at the individual risks with that company because it's not applicable, right? The risks for Cassava Sciences are exceptionally different than the risks of any other biotech company because a lot of the risks is individual, right? And I'll show what I mean by that. So you're going to see right here that this article on Seeking Alpha says that this company has had a lot of controversy and speculation over the past year, right? You're also going to notice that short sellers and citizens have actually filed a petition with the FDA against Cassava Sciences over the past year. And Cassava Sciences also filed a lawsuit against people basically saying that they're, um, manipulating the market. They're, saying negative things about the stock, trying to tank the stock price, right? So there's a ton of information here. I'm not going to really delve into all of it, but I will have the link attached. So that way you guys can take a look at what I'm talking about. They do have a couple of key things to note. They do have they do have a phase 3 trial going on at the moment for their Alzheimer's drug. So what we kind of have to do here is we have to cipher through this and say, is this a risk, right? Notably this, right? That's a huge risk, right? Let's say the FDA rules in favor of, the short sellers and, the scientific community and the citizens that are against this, right? If that happens. Well, what would happen? The stock price would tank, right? And here's the part that we don't know. We don't know when this ruling is going to happen, right? From what I've seen, we really don't know when this will come out, right? And even when it does, there could still be more additional legal speculation with this company because this company has proven that it has a ton of legal speculation. So what we have to do is we have to go through this and all this data that we can find about the company and basically say, based off of all of this, should it be quoted at this, right? And this is really hard on a qualitative sphere, right? It's really hard to just look at, legal risk and say, well, what should it be quoted at, right? Really hard to look at, pending drug cases and be like, well, what should it be quoted at, right? It's very difficult to pin down. However, it is crucial and imperative to understand what is going on with the company because that way you know what to expect if this realizes more than it's currently implying and what would break your forecast, right? So if you analyze this, right, for example, let's say I thought that this level of IV was expensive, and I was looking here and I saw this, I'd say, well, yes, this is a risk with the company. This is definitely why this is contributing to why it might be more expensive than I think it, or more expensive than I think it should be. Well, now I know one the risk that I'm taking, and if I don't think that this is going to happen, so again, going back to this example, this has been something that's been going on with this company for as it says, 12 months. So what's to say that it wouldn't go another month without any clinical or critical concrete ruling or any critical blowout news, right? That's one way of thinking about it. Another way of thinking about it is what other people do, some people, which is block it out, right? Take this from a quantitative perspective, right? We can see historically this does perform well at these higher levels. It typically does not realize even close to what it is implying, as you can see here, right? Now, we did have these periods of realized volatility, which could be due to market volatility. It could have been due to some of their, disastrous performances, like their fireside chat. If you guys don't know what I'm talking about, it was basically a fireside chat interview, and it really a lot of people walked away from it and were not impressed. A multitude of different things, right? Now, how do we structure a trade around this, right? If we were to go with the second route, which is just this is expensive based off X, Y, and Z data that we're looking at in the PA terminal, but maybe that lowers our confidence interval because we don't have a lot of the qualitative side that we would have, right? With another company where we kind of have a better picture, right? Where there's more predictability and certainty. There's more understanding what we think is going to happen with those fundamental risks. Well, guys, here's one way we can do that. If we go down the forward volatility tab and we take a look at what's going on with SAVA Sciences, right? We can see that we're looking at a level of slope right now that is ridiculous on this thing, right? IV 30/60 slope, -51. That's ridiculous. That is ridiculous backwardation. It's not actually I take that back. It's not insanely ridiculous, but it is backwardation nonetheless. And we can see that this is in some of the steepest backwardation that's been in the past year. It's at 5. So it's in the bottom 5 percentile of what that usually is, of what that slope usually is. And the more contango, the higher that number. So this is extremely backwardated relative to what it's usually at. So what we can take away from that is maybe the term structure is, maybe we can hedge on the quote unquote cheaper options, right? If the 30s we were already looking at, we said these look overpriced, and then we look at this forward volatility and we can say based off of this and based off of this might be the term structure might be steeper than what it should be. Well, maybe we can have a trade where we can actually pay a debit and hedge some of that blowout risks without completely blowing up, right? Looking at the term structure, you'll see what I mean here. We have this is the term structure. This blue is the term structure right now. This green is the term structure last week, right? Not only did volatility go up, it appears that it's gotten steeper, right? We can see that right here. So that being said, right, what we can do is we can essentially place a trade where we can kind of hedge almost this blowout risk with capping our losses. Here's what I mean. Here's the trade right now on the next month expiry option. So January 20th, right? This is the straddle if we were to realize our forecast vol. But you're going to notice that we have blowout risk, right? Huge blowout risk. Okay, where we're only collecting 982 in premium and we could lose, to the downside, essentially double if this went to 0, or if this completely skyrocketed to the upside, infinite, right? Now, here is the calendar. You're going to notice that I have basically just put in the forecast vol for the January 20s, and then the back month, we kept it at 149. The reason we kept it at 149 was because of this. If you look at what the 30 is at right now, last week, right? So if we say this is more suited than what it's currently at, it's at around 150. If we go back here, around 150. So we could make, give or take, $215 depending on realized volatility. If it was realized volatility, it'd be in this range, by the way, just so you guys know. So around 140, 170, depending on the delta, right? And we're only risking $160. That's over 100% return if it comes up to that. So this is a way to help mitigate that risk in times of uncertainty, right? Now, the last thing that we can do, we can validate this, right? We can go here on SAVA Sciences and actually see, is this level expensive? I mean, we kind of already have that gist, but is this expensive relative to what it usually is, right? It's the last thing that I want to touch on. As we can see, it most certainly is. It's 30 divided by the 60. Most certainly is. And now what we're going to notice here is that we should expect the 60 to come down. But remember, we're not, if we do hold this position, the 60 is going to become the 30. If that makes sense, right? Because as time goes on, these 60-day options, as these expire, this becomes the 30, right? So this helps mitigate our risk an exuberant amount if someone cannot come to a valid conclusion about the fundamentals. So you don't have, it's like the best way I can put it is, if you have uncertainty, right, your confidence interval is lower. So you don't want to risk as much when your confidence interval is lower. Now, if you have a high confidence interval, you understand the risks at hand. You do an exuberant amount of research. You're very confident that these risks are not either not going to be realized or they're not that important. Then obviously you can sell something like a straddle if you have that confidence interval. But if you don't, we can use the predicting alpha terminal to still try to get some exposure to something that we think might be overpriced without completely losing everything on this trade if it doesn't work out, right? We're paying a debit of 160, so the most we can lose is 160 bucks versus the straddle where we can lose infinite, right? There's no free lunch in this game, but there are ways that we can help maximize our view and our confidence intervals. So I really hope you guys enjoyed taking a look at that. Basically, understanding when individual company analysis is really crucial on something like the SAVA Sciences, and of course, how to mitigate risks when we are not as certain about a given thing. So I hope you guys enjoyed that one. If you guys have any questions, feel free to message me. And I will see you guys in the next one. We're going to be covering USO and UNG tomorrow. I think you guys are really going to like that one. So that's all I got now, guys. Peace.